All right, guys, I would like to welcome you back to the Restart Speaker Series. Today's sponsor is CTM-CPAs. They are they serve small and medium-sized businesses and focus on providing audits and tax strategies to manage the bottom line. We've actually got one of the partners, CPA, and more importantly, a really dear friend of mine, Scott Weingart, here today. Scott, welcome to the show.
Thank you. Glad to be here, Dave.
So obviously, I know you really well, but the audience doesn't. So tell us a little bit about your background personally, and then we can kind of get into a little bit of the career and the background of the company, and then we'll get into the tax strategies.
Sure. So Dave, I got my accounting degree at University of Illinois many decades ago in the 80s, and I also stayed at U of I. Have a law degree as well. I started my tax career at Arthur Andersen. From there, I came to CTM in 1988. The firm actually started in 1973, so it's a little bit older than I am as far as my career goes. But I've been there ever since, and I am now the managing partner, and my concentration is in the income tax area.
Okay. Great. So let's dive in here. So I'm sure you get the same questions over and over again, and I know I've asked you some of these questions as well. So let's talk about kind of flow through, and if I'm taking a distribution for my business, right? So I've got my LLC. I'm rolling into the end of the year. Beginning of the year is tough due to COVID. And I happen to have a really good end of the year, and I'm looking to take a distribution in terms of a bonus or extra salary. Tell us a little bit about what that looks like and strategies that you would advise a client.
Well, the question that I'm always asked is, should I take a distribution now or should I wait until the year's over? Because many of the clients, they think that if you take money out of a flow-through entity, and very specifically, we're talking about, either a sole proprietorship, an LLC treated as a sole proprietorship, a partnership, a subchapter S corporation. We're not talking about C corporations. Right. But if you take money out, does that cause you to have to pay income tax on that distribution? Mm-hmm. And the answer to the question is no. If you're in a flow-through entity, generally no. If you're in a flow-through entity, you are taxed on your net income, which is defined as revenues minus expenses. Mm-hmm. So whether or not you take any money out of the business, you're still going to pay tax on your net income. So I always use the easy example. If you have $1 million of revenue, you have $900,000 of expenses. Your net income is $100,000. Suppose you take out zero. What are you paying tax on? 100,000. Suppose you take out 50,000 in my hypothetical. What are you paying tax on for the year? 100,000. Suppose that you have excess cash in your account, maybe a loan, maybe money from prior years. You take out 150,000. Mm-hmm. In general, you're still taxed on your net income, $100,000 in my example. So very common question. People ask me all the time. I go through the same example all the time as well.
So, I reflect back to my finance days when we learned about time value of money. For those of you that didn't take finance classes, the whole notion is $1 today is worth more than $1 tomorrow. So LLC, I've had a good, fourth quarter. And I say, okay, Scott, should I roll this into next year because maybe I'm going to have a bad year next year, or maybe I'm going to decide that I want to put some money back into the business. So if I'm sitting on a bunch of cash and we're in December, what advice would you give me?
Well, again, from a tax standpoint, on a flow-through entity and I'm giving you a very general answer, the amount of money that you pull out of the business is not going to affect the level of taxable income that flows through to your personal return. As far as your question, should I leave the money in there? That's a question that's up to you as a business. There's uncertain times now. We're heading into 2021. The vaccine's coming out, but depending on what type of business you're in, you may foresee a down first quarter, and you should leave some money in the business and leave it there as a just in case, even though you've earned that money and you could pull it out without any income tax consequences. Maybe you should consider leaving it in the business until next quarter.
So I didn't talk to you about this question before, and you might not like this one, but I'm going to hit you anyway. So because we had this conversation sometimes. So what are the biggest mistakes that you see people making in terms of write-offs? Because obviously this is a big thing, and people are like, well, we can write off that trip when we go to Disney World and I'll meet my buddy, right, for lunch, and then I'll write off the whole trip. I mean, what sort of the top, I'm not going to say top 10, what are some of the mistakes that you see people making?
Well, I mean, I always say that we are not a police officer. We don't work for the IRS. We're your financial advisor. So I can only tell you what the rules are.
Right.
We're not necessarily auditing you personally, unless it's flagrantly, but you need to substantiate any business expenses that you're putting through the business. I mean, frequently we see people trying to put through personal expenses, whether it's a family meal, or whether it's a trip that they took that is not really a business trip, or whether they took their family with them and trying to put that whole trip cost through for their whole family. You have to be able to substantiate it. The expenses you put through have to be connected with your business. And there's been some changes in the travel and entertainment area. First of all, entertainment is no longer deductible at all. So if you take a client out to, a ball game or a concert, you cannot deduct the cost of the entertainment anymore. What you can deduct is the cost of 50% of a meal that you pay for. But again, just charging it on your credit card and having a credit card statement, you need to keep the receipt. You need to write on the receipt who you met with, the purpose of your meeting, and what you discussed. And you need to keep that in your record. So you don't need to give it to your accountant, okay? You need to keep that in case you're ever audited. That's what you would have to produce or substantiate your business expense.
Okay, so let me hit you with a couple others. The ones that I receive from small businesses and startups are car expenses, right? Mileage versus the lease cost of the car, and then home offices. I mean, those are two bigs, especially for consultants, solopreneurs, especially now in the era of COVID, right? Where a lot of people are working from home. I literally had a friend that's a cybersecurity consultant. He said last week, hey, dude, can I write off my office? And I'm like, well, watch the show, because Scott is going to tell you that. So let's talk home office and cars.
So on the cars, yes, I mean, if you have a company car, either the title, or if you lease it, the lease needs to be in the company name, not in your individual name. If you have a company car, that way the company could potentially take depreciation on the car, or it can deduct the lease cost.
Gotcha.
But the one thing that's really required, which I would have to say in practice a lot of clients don't do, is they're required to track their mileage. Okay. And that's a very onerous task. Every time you get in that car, you need to determine, are you driving for business purposes or personal purposes? Because at the end of the year, you have to have a log that shows how many total business miles you drove versus how many personal miles.
Right.
And if it's a company car, there's an add back that's required for tax purposes, that you add it back either to your wages, or you add it back as
that add back. What is an add back? Can you be specific about that?
There's a lease value depending on the value of your car. And so if you have a $40,000 vehicle, it might say that the lease value, I'm making the numbers easy and making them up, the lease value is $10,000. And if you told me for the year that you drove 6,000 business miles and 4,000 personal, your personal use value is 40%. So, 40% of 10,000, you'd have a $4,000 add back either to your wages or as a non-deductible expense on your Schedule C.
Okay.
So you need to keep track of all in a logbook. Now there's apps out there that you can use, and you pull out your phone and smartphone and you could activate it and it'll track all your business and personal knowledge. Again, many people don't do this, but as your accountant, when we're at the end of the year, we'll ask you, your company car, how much business, how much personal. If you make it up, again, I'm not a police officer. I'm not going to say, well, let me see your logbook. But if you were audited, you would need to produce that logbook.
That's on you, not you. That's on them, not you.
I've been involved in audits, and the IRS has asked for the logbook. And, I've seen, sadly, some people go back and try to reconstruct an entire year's worth of driving activity.
I can't imagine that someone would do that. All right. So we'll get back to the other ones, but this is a huge one now, especially, in the era of COVID. People are working at home. Talk about what you can write off and you can't write off in terms of home office. I mean, everything from whatever, writing off a percentage of your mortgage or putting new carpet in or getting inkjet cartridges. What sort of stuff? I hate to say.
Well, first of all, let me go back.
Write up. What can't you?
Let me go back and say that, first of all, you gotta not have an office that you're driving to. So in other words, if your business, you have an actual office,
right?
You can't also deduct a home office. Your home office is there because you don't have an office. Like you said, you're a consultant. You work out of your house. You yourself, I mean, I know you're in the education business, but you're also a consultant. So that one's a little bit more gray for you personally. But if you don't have an office, you work out of your house. So then you need to, number one, keep track of, what's the square footage of your office in relation to your home, all right? And if you determine that, I have a 3,000 square foot home and my office is 300 square feet, so now you're talking 10%. 10% of your house is an office. And so in that situation, you can deduct as a percentage, 10% of the utilities, 10% of the insurance on your home, 10% perhaps of your internet connection. Although you might say, well, I have a dedicated internet line. In that case, it might be 100% deductible, not subject to the 10% number that I'm telling you about. Your real estate taxes, your mortgage interest. Again, 10%.
Here, two biggies. Okay, so your mortgage, okay, the biggies are your mortgage and your property tax. I think you just hit on those. So what can you or can't you write off relative to those payments?
Well, again, if you have a mortgage and you have real estate taxes, theoretically, you're able to deduct those anyway on Schedule A of your personal return. It's an itemized deduction.
Gotcha.
So having a home office may or may not give you any benefit in that area. It's really, when you boil it down, it's some of the utility costs and the insurance costs. Those aren't itemized deductions that you may get to deduct as part of your home office expense as well.
Gotcha. All right. So let's get into the dreaded extensions. So I, for one reason or another, let's say I wasn't prepared and I came to you and you said, wait a second. You don't have all your documentation, or probably the more common one, you don't have the money. Let's say I don't have the money to pay my taxes. Talk about kind of the process of extensions, what I have to do and what you do, and maybe what do I have to be prepared for in the future? Is it quarterly payments?
Okay, you froze up, so I don't hear.
Yep.
I get the gist of your question. So, the first question is, should you be going on extension? And the one thing, let me say up front, is an extension extends the time for filing your return. It does not extend the time for paying any potential tax liability. So, if we're talking about your individual return, your return's due on April 15th. You can get an automatic extension that extends you till October 15th. Okay. But based on the information you have at the time, we have to determine, well, what do we think your tax liability is? We compare that to what's been withheld if you have wages, what you've paid as far as estimates do, and we do our best to gauge what you might still owe on April 15th. And if we think you owe, with your extension, at our firm, we file electronically. We would have you submit a payment with it because we try to get you paid in full. Now, the question is,
hang on, that's a really important point. So you said paid in full, but you can do estimates and make whatever, you get the coupons or whatever, and make quarterly payments or something like that as well, right?
well, we usually, when we extend somebody, we usually, your first quarter payment for the next year is also due on
You can
April.
move your camera,
Sure.
or like maybe move it.
Sure.
There you go. All right,
Okay.
perfect.
The first quarter payment for the next year is also due on April 15th. So we normally build that payment into your extension. We're actually having you overpay. And then if we're exactly right, whatever you're overpaid, we're going to apply that is your first quarter payment to, say, 2021. We build in cushion, and we usually do it with that first quarter payment. But the thing is, let me just put this in perspective. Okay. We have approximately, we do over 2,000 returns a year.
Wow.
Half of them go on extension.
Really?
And the one thing that I want to make clear is, there's many reasons you go on extension, and a lot of it's because you don't have all your information. If you have investments, you're getting Schedule K-1s. Many people don't have all their Schedule K-1s by April 15th. That's the reason why you go on extension. I mean, some people
explain what a K, just for those that especially are just starting out, maybe they've taken on an investment. Can you explain K-1 to the audience?
So a K-1 is your share. It's a piece of paper. It comes from a flow-through entity like a partnership or an LLC, treated as a partnership or a subchapter S Corp.
Right.
Shareholders of an S Corp, the members of an LLC, the partners in a partnership. The end of the year, if there were 4 partners and there's $100,000 of income, each of the owners of that business is going to get a K-1 showing $25,000. That's 1/4 of the income for the company. In my hypothetical, you're going to get a K-1 showing that amount of income. You take the K-1, give it to your accountant. He reports it on your personal income tax return. So that's how a flow-through entity works. You may not have all your K-1s by April 15th, especially if you have investments out there, and many of those investments, they themselves go on extension, which means that the business has until September 15th to file a business return and generate the K-1s. Your personal extension extends you till October 15th. So a lot of people think that accountants only work until April 15th, but that's nothing farther from the truth. We have many business returns that go on extension. We're finishing them up. The last 2 weeks before September 15th is hectic, and the same thing the last 2 weeks before October 15th. We're finishing all the returns that have gone on extension. Now, let me just address one thing, Dave, with you. The question that I'm always asked is, if I go on extension, does it increase my chances of being audited? And the answer to that question is no. There is no statistical evidence that says that because you went on extension, you're going to be audited. I mean, let me put it in perspective. The overall chance of an individual return being audited is 0.4%. So
when you said an individual, me personally, or
you personally?
Okay.
You personally. The IRS just doesn't have the manpower anymore. They've faced many budget cuts, and so the amount of actual in-person audits has gone down tremendously to this 0.4. Now, I will tell you that if you make $1 million a year, your chances might be 2%. Okay.
Yeah.
But if you're somebody that makes $50,000, $100,000 a year, you're probably under 0.4% chance.
Not that we would play the odds, but
no, you don't play the odds. But
okay. So all right. So let's you've got a tax bracket grid. Would you like me to bring that in?
You can put that up, Dave. So, another question that I'm commonly asked, that people ask is, you hear people say, does it pay for me to work anymore? If I keep working, it's just going to cause me to pay more taxes.
Right.
And, yes, the answer is partially true. Of course, if you earn another dollar, you're going to have to pay tax on it. But the reason I had you put these tax brackets up is to show you that the tax brackets are graduated, meaning that every person starts out at the lowest bracket. Let's just talk about, for purposes of this discussion here, a single taxpayer from 0 to 9,875, you're taxed at 10%.
Right.
Your taxable income between 9,876 and 40,125, you're taxed at 12%, and so on down the bracket. So the highest tax bracket, the 37% bracket, doesn't kick in until you've earned more than $518,000 single, or if married filing joint, 622. At that level, that's where the rest of your income over that level is going to be taxed at 37%. So when someone says, well, does it pay for me to work? The answer is yes. Of course, you're ahead of the game, right? If you're in the highest bracket and you're at a 37% tax rate, okay, so you pay 37% federal tax plus your state tax on that income, but you still have 63 cents in your pocket. So the answer is yes, of course it pays to keep working. It doesn't cause all of your income to be taxed at an overall higher rate.
Right. Okay, so let's get into with COVID-19. Obviously, Congress passed the CARES Act. What are some of the kind of the nuances, the tax provisions relative to that?
Well, I don't know how much time we have here, Dave.
Yeah, we've got like 5 minutes or so.
Okay. Let me just put this plug in here, and maybe you can put the information up later. But a week from today at 11 o'clock, I'm actually going to be doing a 1-hour webinar. Okay. CTM is doing a 1-hour webinar. And so I would encourage any of your listeners that want me to go in more in depth on a lot of what's taking effect in 2020 and 21, and actually going backwards as well. There's a lot of opportunities to amend returns. If you want to hear more in depth, if you put up the information on how to sign up for our webinar next week, it'll be very informative. Now, with the pandemic, Congress passed the CARES Act much earlier in the year, and there's a lot of really great provisions in there that a lot of your listeners can take advantage of, okay? Yep. So let me just tell you, the first thing people are always asking about is their stimulus checks, right? There's a $1,200 per person stimulus check. Some of your taxpayers may have received it already. Some may not. And the question is it still possible to receive a stimulus check in 2020? Well, you may not be able to get a check, but if you didn't qualify to get a stimulus check in either 2019 or 20, okay, if you didn't qualify to get it, you can get a tax credit on your 2020 return if your income qualifies. So what I mean by that is your income has to be below a certain level. So if you file single, $99,000. If you're actually, it's based on adjusted gross income. That's different than taxable income. That's your total income in total. So if your AGI is less than 99,000, you're single, you may qualify for the credit in 2020 on your return, even though you haven't gotten in the prior years. Married filing joint, that threshold is 198,000 of AGI in order to qualify. So that's one of the things just to keep in mind. It's still possible. A couple other things, charitable deduction. There's a new $300 charitable above the line deduction that's available. And the reason that's important is because many people don't itemize their deductions anymore. Itemized deduction.
Hang on, why is that? I want to understand that.
So let me just recap what is an itemized deduction.
Sure.
It's your state taxes, your real estate taxes, mortgage interest, charitable contributions, possibly medical expenses. The way that the law changed is that they have now limited state taxes and real estate taxes to a maximum deduction of $10,000. And that's really critical because depending on how much you pay in state taxes, and that depends on what state you're in, your state tax rate, real estate taxes. Some people own more than one home. The most you can deduct is $10,000. It's called the SALT limitation. So because of that, depending on how much mortgage interest you pay, depending on how charitable you are, you get the standard deduction, which is for 2020, $12,400 single or $24,800 married filing jointly. You get the greater of your itemized deductions or the standard deductions. It turns out that really with this change that came about in 2018 with the TCJA, the Tax Cut and Jobs Act, really only 10% of the tax filers are actually itemizing their deduction. The majority of the people are actually taking the standard deduction, the gimme, what you get, 12,500 individual, 24,800 married filing joint. So what I was saying here is, again, it's a small number, but they are now allowing you as part of the CARES Act to deduct $300 above the line. They're carving it out. You can take it directly against your income, $300. Again, I know we're pressed for time here. Let me just cover a couple of the other critical things that people ask about. Retirement plan distributions. Yep. You can pull money out of your retirement plan, either your IRA or a 401k. And if you're under the age of 59 and a half, there's no more 10% early withdrawal penalty.
Really?
The CARES Act took that away. They've also let you spread the income tax effect of picking it up over a 3-year period, 2020, 21, and 22. So if you took out $30,000 out of it for COVID-related costs, either your lost income or you have higher medical expenses, that's the reason you pulled it out. You can spread that hypothetical $30,000 retirement plan distribution over 3 years, $10,000 this year, $10,000 next year, and $10,000 in 22. They also let you repay it. So if you want to repay it, you can put the money back in and completely eliminate any tax consequences if you are able to repay the retirement plan distribution. Another thing that people ask about, qualified distributions from, minimum distributions from a retirement plan. They have waived that for 2020. And the reason I bring it up right now is a lot of people wait to the end of the year to actually take their required minimum distribution. So if you want to waive it, you don't have to take it. There's no penalty for not taking it. And then someone will ask me, well, do I have to double up and take 2 in 2021? The answer is no. You're just waived. You don't have to take a retirement plan distribution in 20. A couple other big things, net operating losses. The prior law required you to carry them forward. Now you can carry back losses 5 years. And you could actually carry.
Oh, wait, hang on. This is super important, especially for startups and startups that are running a loss for the first couple of years. Yeah, this is critically important. Let's dive into this a little bit.
So the way under the TCJA, they changed the net operating loss area to say that if you have a loss in a given year and it wipes out all the income on your personal return, you can only carry that loss forward and use it against future years' taxable income. The CARES Act said, you know what? We're going to let you carry those losses back 5 years. And they let you look back at your 2018 return or your 2019 return and for 2020. So it's only these 3 years, and they will allow you to carry it back 5 years. So your 18, if you had a net loss on your individual return, and carry it back to 2013, 19 can go back to 14, and 20 can go back to 15. You could file an amended return and obtain a tax refund from those earlier years. And of course, you roll it forward. If it eats up all your, if an 18 loss eats up all your 13 income, then you go to 14, and then you go to 15. So you could potentially get back a lot of money right now by filing amended returns and taking advantage of this CARES Act provision.
Right. Okay. So we covered a lot today. So this is, if you guys want to do a DIY, which I really wouldn't recommend you do. Obviously, it's a great insight. So let's talk about, people want to talk to you, CTM. What sort of services do you provide? Obviously, we've got the URL down at the bottom. Maybe you want to provide email, phone, whatever. So let's talk about the services that CTM provide, and to whom.
Yeah. So our client base is small to mid-sized businesses. We do everything from a client services where we, prepare monthly financial statements. We do bill pay. We do payroll and payroll taxes for clients. We also do, year-end either reviewed or compiled statements. And of course, the full tax area, both we do your business returns, your personal income tax returns. We do tax planning. We do consulting. We do valuation work. So again, focusing.
You're like the financial saviors of small businesses.
Correct. Correct.
Maybe
So,
make that your new tagline. We are your financial savior.
Yeah.
Watching.
So we try to give our clients the best advice to minimize their taxes, within the law.
Right.
And so that's what we do. We have a lot of clients that have been with us for many. I'm not going to say years. I'll say decades that have been with us a long time. I see you have our website.
Yeah, talk a little bit about the webinar. I didn't capture the whole link, and again, Deb is VP of Marketing, so she's probably mad at me. But I'm sure there'll be an announcement on the homepage, so we'll link to the invite. Sorry, Deb. Talk about what it is and when this is taking place.
Yeah, so I did mention it about 5 minutes ago, but so a week from today at 11 o'clock. It'll be 1 hour.
Standard if you're watching us on the coast. Yep. Okay.
Yeah, Central Time. I will be covering a lot of tax information, a lot more in depth. I mean, I had planned to go over as much as I could here.
Right.
I could probably use at least another hour. Even for the webinar, I probably have an hour and a half material to cover in about an hour. But there will be slides. The slides will be available to everybody after the presentation's over, and we will be taking some questions. Try to save the last 10 minutes for questions that people have to ask. I don't know if we have any more time here. I'm happy to answer any.
I think we're probably at time here, but okay. So we've got the URL. If they want to. Do you have phone number, email address, or do you want to just have people direct to the website?
Well, if you go to the website, you certainly can. It'll give you the link and all of our contact information there. I'm happy to provide you with my email. It is SPW, S is in Scott, P is in Paul, W is in watch, and it's at CTM-CPA.com. Dave has that up on the screen.
Okay, so here, can you give me one more time? SP, what was it, Scott?
SPW at CTM-CPA.com.
All right, guys, I'm just going to put that up here. Let's see. Add banner. And okay, is that right, Scott? Right there?
Yep, you got it right. And as far as phone number goes, my direct line is 847-405-09.
Can you repeat that again? You seized up just over the area code.
847
right
405-0926. So 847-405-0926. You can call me anytime as well.
Great. So guys, I cannot recommend CTM enough. Unlike kind of traditional large firms, they're super down to earth, as you can tell from Scott. They give you the guidance. They're not going to charge you $2,000 an hour. So it's really professional advice. You're getting, Big Four caliber consulting and tax and auditing, but super, super friendly and affordable. They're not $5 an hour, but they're not $2,000. So, and I'll leave the rest up to Scott. So, Scott, again, thanks for being here. CTM, thanks for sponsoring the show. Have fun out there, everybody.
Okay. Thank you. Thanks, Dave, for the opportunity.
Great having you, Scott. Thank you.
All right. Bye-bye.
Bye.